Let's get started then. So today we're going to talk about Chapter 4, and we'll be learning about the measurement of GDP. So we're learning exactly what it is, different ways of calculating it, and its importance. Gross domestic product. Gross domestic product is the market value of all final goods and services produced within a given country. You could think of an Excel spreadsheet with the first column having a list of all of the goods and services, the second column being their prices. And so gross domestic product is simply the multiplication of the prices times the quantities, and then for each of them, and then you would take a sum of that. And so we're going to talk about four different aspects of this definition: what we mean by market value, exactly what I mean by final goods and services, and what we mean by produced within a country and in a given period. So again, the definition is the market value of all final goods and services produced in a country in a given time period. So I'm just going to go into more detail now on the aspects of this definition. So what do we mean by, well, market value that the good or service has been sold on a market, And a way to really understand this is to think about what else we could do. Well, we could just add up or count all of the goods and services, but that's not going to tell us all that much because differ substantially. Think about a car and a haircut. If we had 1,000 haircuts consumed in the economy in one car, then the total value of goods and services would be 1,001. But what if the car wasn't produced? Well, then the total value measured that way would only be 1,000 rather than 1,001. But the car is much more valuable than the haircuts, right? So it doesn't make any sense to just count the number of items that were produced. We obviously want to use dollars. Now, money is a unit of account. Otherwise, all we could do is just relative values of each good to other values, like maybe one table is worth. So in order to, if we didn't have money, we would have to somehow value goods and services in terms of other goods and services. And then how do you pick what the relative should be, and would it make sense? So long story short, obviously we want to measure GDP in dollars, and we're measuring it in terms of its final value. So that's the second item here. So we look at just all of the final goods and services sold. In other words, we're only counting when the good has been completed, or finished its production and sold to the consumer. What did the consumer pay for that in a market? And that's what the final value is. The reason why we only want the final value is that we don't want to be double counting. If we were to include intermediate goods like the screws or wood as part of a table, well, then we would be double counting, right? If you added the final value of the table and then also added the screws and wood, then we're going to be overstating what the value of the table is. So that's why we only look at the final goods and services. Now, gross domestic product is what's produced within a country. So this is regardless of the citizenship of the firm owner. So if there's a foreign firm in Canada that's producing stuff in Canada, we include that in our gross domestic product. But if there's a Canadian who owns a business in France and they do some production in France, we're not going to include that in gross domestic product. And gross domestic product is the most common measure that you will see in the news example, for example, and it's one of the most important economic indicators. Now, there are other measures, like we could look at gross national product, which would exclude any foreign production within Canada, but then include any Canadians who are producing elsewhere in the world. So one thing to point out too is that it's only looking at domestic production, right? As I said. And so that means that it's not going to include imports. So gross domestic product wouldn't include many of the items that you would buy at the dollar store because they've been imported. So that's the difference between gross domestic product and gross national product. As you can see in this diagram here, gross domestic product just includes what's production done within the borders, regardless of the nationality of the firm owners, whereas GNP would only include things that are produced by an American firm. It would also include anything outside of Canada, or sorry, in this case, it would be the United States, outside of the United States that would be produced by someone who's American. And then the fourth one is just, it's very clear. We usually measure it over a certain period of time. Okay, it could be a month, quarter, or a year. That's the usual time periods that are measured. Now let's talk about the fundamental identity of national income accounting. Okay, so this is an accounting framework that's used to measure current economic activity. So we're going to talk about this identity here. And we're going to spend a little bit of time on this just to drive home the point. So in an economy, the value of production is equal to total expenditures, and that is also equal to total income. And the value of production is obviously equal to gross domestic product. So this is the fundamental identity, and it'll be useful because of this identity. We have different ways of estimating what gross domestic product is in the country. So anyways, these three different ways are the production approach, which is basically what I said earlier, where you would just multiply the prices and quantities of each good and service and take the sum, the final goods and services. But we can also measure gross domestic product by summing up all of the spending in the economy. And we can also estimate gross domestic product by summing up all of the incomes in the economy. So let's, go into a little more detail here. So one way to see this is the following. So let's just suppose that in an economy, there's only one good produced, and it's a car, and the total value of that production is $20,000. It's easy to see that this amount, the $20,000, is going to be income to all of the factors of production, right? If you work at the car manufacturing firm, you're going to get a wage. And then the firm's going to use some capital. If it, rents the capital, it'll pay interest. If it owns the capital, then you could think of it as just paying that interest to itself. In any case, there's going to be, a portion of that $20,000 that would have went for capital, the plant and machinery. They also use land. So if they own the land, then they're paying rent to themselves. But if they lease the land, then they're paying that to someone else. And then whatever's left over from that, the car sold for $20,000, and the costs of production here so far are $16,000. Whatever's left over is profit, income to the owners of the firm. So the total value of production, this $20,000, can be, broken down. It becomes income to all of the factors of production. So 10,000 would go to wages, 4,000 to interest, 2,000 to rent, and 4,000 to profit. And so total production is clearly going to be equal to total income in an economy. What about expenditure? Well, every buy and sell transaction is income to one sector and spending to the other. Total income then will equal total expenditures. And so this implies that total production equals total income and total expenditure. So let's take a look at the circular flow of income to get some more insights on this. This is a very simplistic overview of an economy. So we're going to start with a very simple version, and then we will add a few things in a moment. So we begin with firms and households. And I mean, just think about, any group of human beings in an economy, you have households and then you have firms. Firms are just separate entities, but they're owned by households. These are the two different sectors of the economy, you could say. Of course, all of the firms are owned by households, but we're making a distinction. We're thinking of a firm as sort of as a separate entity, right? So firms, what do they give to households? So now we're thinking sort of the production flow. So firms, they make goods and services. Those physical goods and services are used by households. So they're provided by firms to the households. And what do households give to firms? Well, they give the means to produce those goods and services, right? Firms use land, labor, capital, and enterprise. So I think the first three are clear. Enterprise is also labor, but it's just a more specialized category. Here we're talking about, the entrepreneurial skills of the owners of the firm, or, the management skills and that sort of thing. Okay, so that's the physical production flows. Now there are financial flows. We know that households buy the output, right? So that's the red arrow here. And so this is measuring expenditures or sales revenue. Okay, so the households will spend their money, on the goods, and that's an income flow going to the firms. Now, what income flow is there from firms to households? Well, firms, provide income to the factors of production: rent, wages, interest, and profit. And so that's the outer red flow here. And so just to go a little more detail here, so rent is the income received for the use of any natural resource. Mostly we think of land. Wages, income received for labor. Interest is, as I said, received for the use of capital. And then whatever is left over from this will be profit, right? And that is going to be income to the entrepreneur. So that's like sort of a reward for the enterprise. So that's a general, simple version of the circular flow. Now, we call the top section here where the goods and services are, traded for money. So this is consumption, expenditures, and goods and services. This is the product or goods and services market. And then below, this is called the factor market. It's important to point out that at this stage of the model, this is a very simplistic model. We will complicate it a little bit in a moment, but this is a closed loop. You can think of this, the financial flows here. Now, what's going on here? So you have firms make stuff, they produce something, right? And then they pay income. That becomes income to households. So, when they make stuff, people are paid their wages, et cetera, whatever's left over is profit. So you have some stuff that's produced. And when that's done, you've generated income for households. Households then, in this model, have no choice but to just spend it all. We're not allowing in this model for any savings or taxes or imports. So those are called leakages. So we can think about water going around. Imagine this was a hose and there was a certain amount of water going through, and you can think of a certain amount of water pressure. That would be representing the flow of income. Well, here there's no way for any water to leak out of there. And so the pressure is always going to be the same. So we have this closed loop. Whatever's produced, people buy. All the households spend all of their money on it. And so the value of production here must be equal to the amount that buyers must spend to purchase it, right? Because they can't save or anything. All income is spent on the output produced. So clearly we can see the first part of that identity, that the value of production is equal to total expenditures. Now also total expenditures, so that's this red arrow here, is equal to what the firms receive, okay? The amount the firm receives is equal to the total income generated by production. Basically, we're just pointing out here that, these two red arrows here, the one on the top and the one on the bottom, are equal to each other. In other words, total expenditures equals total income. And so again, we have our identity. The value of production equals total expenditures is equal to total income. Let's look at just another quick illustrative example to drive the point home. Suppose that we have a very simple economy. There's 3 businesses and there's actually just 3 households. So we have Bill, who owns a bakery. Annie owns a natural soap making business, and Tammy has a tailor shop. So within this economy, there's only a single $10 bill, which is currently in the possession of Bill the baker. So now suppose that Annie makes soap. Bill, who initially has the $10, buys it from Annie. Okay, so now Annie has, $10 in income. And then Annie's going to spend that $10 on jeans from Tammy the tailor. Now Tammy has the money and she's going to buy $10 worth of bread from Bill. Okay, so let's suppose the simple economy, that's the only economic activity that happened. Well, then what is the total value of production? $30. What is the total value of income? And what is total spending? Also $30. So it should be kind of clear right now. This simple economy clearly illustrates the equality of all of these 3. So here we had total production, which is, the final value of all goods and services. Will happen to be in this example, they're $10 each. The total expenditure was clearly, each time they spent money was $10, so 30. And total income, each made $10 from selling their goods. And so all of these are equal. Does this, equality always hold? Is it a coincidence? So far, the economy was a closed loop. And so, is it always in like an equilibrium? What if there's not a closed loop? So we'll answer those in a moment. One thing to point out is that these three quantities that we've talked about are, very important macroeconomic aggregates. So, we are very interested in how much production's done in the economy each year. Expenditures are very important to look at, and so is total income. We're going to complicate it a little bit, and we're going to add to our circular flow like a financial intermediary. We're going to add the government, and we're going to add a foreign sector. Again, we're going to make this more realistic. So, of course, not all of the income that people get for, these households get from production will immediately be spent on the firm and go directly to the firm. Part of household income can be used for savings, right? We can put it in a bank account and not spend it. In the model, simplified model, we didn't have that option. Also, the government takes some of our income in the form of taxes. And then if you have foreign trade, we can spend some of our money on goods from another country. So we call these leakages. If we have savings, then it's possible that the amount of income won't equal the expenditures. Well, we'll talk about that in a sec, but just keep that in mind. So we're going to introduce leakages from the circular flow, these three things here. We also have corresponding injections. If people save money, well, that provides funds that could be loaned out. And a lot of times they could be loaned out to consumers. We'll just keep that in mind, but we'll focus more on the fact that a lot of times these funds can be lent out to businesses for investment. So the corresponding injection to savings would be investment. So we're not talking about buying stocks or anything like that. We're talking about a business borrowing some money for a new tractor, or like a farm, borrowing some money so that they can invest in a new tractor for their farm. Now, the corresponding injection for taxes, the government just doesn't take tax money and sit on it and don't do anything with it. They buy goods and services. Okay, so there's government expenditure. And so that's the corresponding injection to tax. Next, we have exports. If we're open to free trade, then usually it's not just a one-sided thing. We also export. So we have imports as a leakage, and then exports is an economy will be in equilibrium when the total amount of injections equals the total amount of withdrawals. We'll discuss that a little bit in a sec, but what you can think of, if you remember the circular flow diagram and how I was saying that you can think of it like a hose with water pressure. Well, the economy is in equilibrium when, every time you go around, the pressure is the same and there's no tendency for that pressure to change. But if, for example, savings were to increase, then you would have a leakage. And so the pressure would start to fall. And then an injection of investment would offset that. So, but if savings and investment, if we only had savings and investment, then the economy would only be in equilibrium if savings was equal to investment. But we also have the other injection. And so for the economy to be in equilibrium, we just have to have the total leakages equal to the total, right? So savings doesn't have to equal investment, and taxes don't have to equal government purchases, but the total sum of all three of each of these have to be equal for the economy to be in equilibrium. If we were to have all of it, so suppose we have all three of these new sectors and all of a sudden there's a new investment. So money is spent on investment, business investment. Now you'll be out of equilibrium. The pressure of that water going around will increase. But as it increases, it's going to be slowed down by higher, that means there's more income now, but that's going to be slowed down by taxes, imports, and higher saving. And so you'll end up getting to a new higher equilibrium. And then in the analogy here, it would just mean you'd get to a point where the water pressure has increased in the hose, but then now it has increased, but then slowed down and remained constant. So it's at a higher level, but now it's constant again. So that's the idea here. So we can think of, first of all, an equilibrium, just a general definition, is when or any system, it's just if you think of any complicated system, or not even have to be complex, but any system where the forces acting on it are balanced. Okay. And so it's in a state where there's no tendency for change. In an economic equilibrium, we're just talking about a condition or state in which the economic forces have all balanced out. And in effect, economic variables remain unchanged from their equilibrium values in the absence of any external influences. So in this case, an external influence would be like this exogenous increase in investment spending, or if everyone just decided to be more thrifty, then savings would fall. And so in order for the economy to be in equilibrium, as I said, you have to have injections equaling withdrawals. When the level of injections is equal, we're equal to the level of withdrawals, we're in equilibrium. The sum of the injections is greater than the leakages, then the level of income will rise. We'll be out of equilibrium for a while, but imagine here, so all of a sudden, if you have more, you have a jump in investment, that means production has increased. That becomes, so income now has increased. And so, that's the economy growing. And income will continue to increase. Pressure of water will continue to increase, but it's going to be slowed down. What do people do when they have more income? Well, they save more. There's going to be more purchases of imports, and there's going to be more taxes paid. So it's going to be slowed down. You get to a new equilibrium. And then, you could think of just going around the circle again. Production would start to increase. What's going to slow it down is that there's going to be more of the leakages. So more people are going to save more, import more, and there's going to be paying more taxes. So that will slow it down. You'll just get to a higher level. Okay. Yeah, and I have this diagram too as well. So what we're interested in is this flow of income here, right? So you see this going around. Here is a leakage. So any leakages will slow the pressure going around here, right? So this is a leakage. Imports are a leakage. Taxes are a leakage. But then you also have injections, right? Government spending. The counterpart to savings is investment. And the counterpart to imports is X. So if this flow plus this flow, right? These are all the leakages. So this plus the other leakages here are equal to all of the injections, then the pressure will stabilize and you'll be in if all of a sudden you have an increase in investment, right? The pressure will increase in this hose, right? So all of a sudden you push some more water in here, it increases the pressure. If that's all you had and nothing else changed, it would just increase the pressure forever. But well, you can think of it like that. It'll increase. The amount of savings will increase. So this will slow it down more. And eventually you'll just get to a new overall equilibrium. Again, this is just a summary here. So savings and investment are the two corresponding counterparts, I guess you could say. And then you have taxes and government spending, imports, and exports. And this is just for your notes to have. I just gave you another diagram for you to look at when you're studying. Okay, so we know it's, so now it's on a closed loop, but we still have the same result. The big issue sort of to get around your mind is whether or not, is that income now won't equal expenditure, because you could have people saving, right? Or, you could have the other leakages too. You have imports and taxes. So, what's going on? Well, we just need to recognize that if there are any unsold goods, right? Again, so just think about the economy produces a bunch of stuff that becomes income, but they may not spend all of that income on goods and services. Three-way equality doesn't hold, but because there could be unsold goods. But
like it's like the charity, like I produce it, but I'm not selling it by price. I just freely give to another one or something.
Well, here we're just thinking, everyone has an income. They may not spend it all. They may save it, right? So all of the goods that are produced in the economy may not, three-way equality won't hold. When we have unsold goods, we can think of them being purchased by the firm because they made them, right? And so you just keep that in mind. So unsold goods or inventory accumulation, we just consider as an expenditure by the firm. So we treat it as if the firm just purchased them from themselves. And so we still have all of these three things being equal. what's interesting about that last discussion is that we essentially have three ways that we could estimate gross domestic product, but the statistical agencies typically just use two different ways because it's very hard to get an exact list of all the goods and services. What we could do, though, is just look at expenditures in the economy. Okay, so we can estimate gross domestic product simply by summing consumption expenditure, investment, government expenditure, and looking at net export. And then the other approach, we'll go into this in more detail in a moment. And then the income approach is essentially just going to measure GDP by summing all of the incomes of the factors of production. Here's the expenditure approach. So here we're thinking about, there's a flow of income from households to the firm. Goods are traded in the goods market, right? We buy stuff from companies. That's all this is. And then also firms also invest, right? So they're going to buy, say, a new tractor, and they would buy that in the final goods market. Okay, so we have, a flow going here, and governments spend money. And we also have, and that's, if this is positive, then, that's a sort of a positive thing. We can estimate GDP by just looking at the total expenditure. So GDP can be measured by looking at consumption expenditure from households, investment by firms, and government spending. So this is government purchases or government expenditure. Any exports, that's a bonus for us. That's why that's positive. And then imports would be subtracted away from that. Okay, so that's what, remember, imports we want to subtract away. They weren't produced within the country's border. So let's look at a numerical example for Canada. Okay, so this is some data for 2020 from Statistics Canada, and it's looking at the expenditure approach. So in Canada in this year, consumption expenditure was $1.322 trillion. These are in billion. And as a percentage of overall gross domestic product, it's almost 60%. This is the largest component of gross domestic product on the expenditure side. Business investment was $422 billion. The government spent $592 billion. And the difference between exports and imports is actually negative here. So this means that we bought more from the rest of the world than we sold to the rest of the world. So this is negative. And when we add all these up, our estimate of gross domestic product would be 2,297. Okay, so this is just a summary for you to have for when you're studying. This nicely summarized what we just talked about. Now on to the income approach. So the income approach, where were factor incomes presented in the circular flow before? They're in the factor market, right? Households provide firms with, labor and the other means of production. And in return, they get incomes from the firms. One of the main categories are wages, salaries, and other labor income, right? So this is people trading their labor for a wage, right? So firms give households through the factor market their wages, right? And then there's other factor income, the rent and that sort of thing. And we'll just call that other factor income. And then that also is including the profit to the owners of the business. And so so now there's a bit of an issue here we need to be aware of. When we look at if we look at the company's profit, for example, it will have subtracted depreciation, right? When you do an income statement for a firm and then you want to calculate profit, they subtract off depreciation. That's a cost to them because the capital is depreciating. So they write that up. So we basically just need to add that back. Also, here we need to think about the money going to the government. Well, here, when we think about wages, for example, we would be adding here your gross, before anything's deducted from your paycheck. And so we're already then including in there any taxes, income taxes, and that sort of thing. But what we haven't accounted for were sales tax, like HST and that sort of thing. So and then we're also not incorporating any subsidies. Sometimes the government does the reverse of a tax, give a subsidy to companies. For example, maybe daycare in Quebec especially, they provide subsidies to daycare providers. Okay, so we want the net indirect taxes. So we want to add back depreciation and then also add indirect taxes, but subtract any subsidy. Okay, to get Now, these are going to be, Statistics Canada, when they do these, we won't get into the details, but they get estimates of these, and they're pretty reliable. But sometimes the two approaches won't exactly equal each other. In theory, they should, but because we're using samples and that sort of thing, it may not exactly equal each other. So usually the statistical discrepancy, what they do is they take the difference between the two numbers and then just divide that by 2 and then just add a portion to it. The one measure that was lower, it would get that difference added to it, and then the other measure that was higher would get that subtracted, and then you'll end up with two numbers that are equal. Don't worry too much about that, but that's what this discrepancy is. Here's the income approach for Canada in 2020. So we have an estimate here of wages, salaries, and supplementary labor income. That was $1.183 billion. Then we have other factor incomes. And then here we're adding back that depreciation. And then we call this gross domestic income at factor cost. So we're just, it's just because we're not including the HST or, things like those types of indirect taxes. So we just want to add those back but subtract any subsidy. So in this case, the number is 240. So taxes were obviously much higher than the subsidies. And then we end up with 2297. So this happens to be the same number as before. I'm not sure what the textbook did because these are supposed to be numbers for Canada, and there surely would have been some statistical discrepancy, but for some reason the textbook decided just to put it as 0 here. I'm not exactly sure what they did. Just be aware, and in the real figures, there would be some small number because of this, you're going to be taking samples of this. You're not going to have every single expenditure. They're going to take random samples and that sort of thing. So there'll be a little bit of statistical discrepancy. Okay. And again, this is for your notes. This is income approach. Actually, we'll just go over a little bit of these because we didn't really see these details here. So again, the main components of the income approach are compensation of employees. That's the wages part, right? And this is all going to be gross. And then for corporations, we want their profit, right? And we look at their gross operating surplus. And so this is actually before depreciation and taxes. Where we have gross operating surplus, then we don't need to add back depreciation because this number has it included. It wasn't subtracted off. But if we're just told companies, net income or net operating surplus, then we would need to add back the depreciation. And here is gross mixed income. This is similar to this. It's just that we're talking about non-incorporated businesses. These are, just ma and pa type. We're not always, but these are firms that haven't been incorporated. And same thing, gross mixed income would be before depreciation and taxes. And then just think about the overall economy. So what are we missing here? So that any income to capital and all that stuff would have been in here, right? It would have been paid in here. So we have all that. We have that, but we're missing, the money that ended up going to the government. And again, income taxes and all that will be here, right? Because we're taking the gross salaries. And so the only thing we're missing here is indirect taxes like the HST and stuff like that. And so we want to add those taxes, right? Yeah. So they actually put a different one, a newer one in here we haven't seen before. This is taxes net of subsidies on production. So here we can think of property taxes. That's another thing too. Most people who own land and that sort of thing pay property taxes. So we want to add that back as well. We want to capture everything. And then there's the things like HST, net of subsidies. So for both of these, we would be, adding the amount of the tax and then subtracting the corresponding subsidies. We would be adding the taxes here, so all the HST collected, but then subtracting any subsidies related to this type of tax. Because I think that, at some point they might take the HST money they receive and then maybe use it to give some businesses or people, or mostly businesses, some subsidies related to that. So anyways, the big picture here is we're accounting for all of the income in the economy. We've looked, so, at this point, the GDP figure we've calculated. Well, let me ask you. So suppose you're told that in year one, a particular economy has a GDP of 1.25 billion. and that in year 2, their GDP was 1.3. Can you say for sure that in year 2, there is a higher level of economic activity? So I'll open that up to the floor. And what do you guys think? Yeah, you're on the right track, Zuru. So the question was, if you had GDP, okay, I'll actually put the question that I have written here. For example, suppose GDP in year 1 was 1.25 billion, and in year 2, it's 1.35 billion. Can we say that economic activity increased between these 2 years? Sorry, this should be 0.10 here. That's a typo. Let me just, yeah. Daniela, good job. Yeah. In both of the, when we calculate GDP here, we're multiplying prices times quantities, and we're multiplying the prices in year 1 times the quantities in year 1. We're multiplying the prices in year 2 times the quantities in year 2. And so over the course of that year, the prices and quantities change. So it could be that the quantities are exactly the same, so economic activity was identical, but the prices are higher. And so there wasn't any, so we can have this measure of GDP increase without any change in economic activities, because you have two things changing at the same time. And so this measure that we're doing now is called nominal GDP. And it's capturing both prices and quantity. So we want a measure that just captures the changes in the quantities, because one of the main points of looking at GDP data, especially over time, is to see how economic activity is changing. We don't want that confounded with prices. So the name for the measure in which prices are controlled for is real GDP. Real GDP simply holds prices constant over time. So you can think about calculating GDP using the production approach, where you're taking the prices times the quantities in each year, doing that for each year, but just tying down the prices that you're going to multiply the quantities by at a particular year. Okay, so let's look at an example of that. So again, nominal GDP is when you use the current prices. That's what we've been doing so far. Real GDP holds the prices constant in what we call a base year, instead of just always, so we're just tying down the prices and then calculating what GDP would be in each of the following years, assuming the prices don't change. So let's look at an example here. So here we have an economy called student land. And in student land, we have, products that students would buy: coffee, bottled water, photocopies, and pizza. So here, let's suppose, first of all, that the base year is 2008. And so first of all, let's just look at this and understand how we get our nominal GDP in each year. Nominal GDP is simply, as I mentioned a few times, just the quantities times the current year prices, right? So in 2008, these were the quantities of coffee. These were the prices of those goods. So we multiply these together and then take the sum. So the nominal GDP in 2018 is 761.25. Now in 2019, we can see here that the quantities have changed, and so have the prices. So in 2009, when we multiply these and take the sum, oh, that's right, Zero. Inflation is, like prices changing. So we'll get into inflation in the next lecture. But yeah, right now we're just thinking of price changes. Sorry, I didn't see your chat question until now. Okay, so anyways, in 2019, we have nominal GDP being $883.50. In 2020, 1,201.25. And so we can see here that nominal GDP has increased. Just because this has increased, doesn't necessarily mean there's more economic activity. Roughly eyeballing this, we do see some of the quantities increase, but then some of them have actually fallen. So anyways, real GDP, to calculate it, all we do is, first pick a base year. Here we're going to base everything on 2018, the first year. And all we're doing is we're going to tie down these prices. So when we calculate GDP in 2019 and 2020, going to use these prices. We're going to pretend these aren't here. In the first year, the base year, both are going to be exactly the same, because the base year prices here are for 2018. So you're going to have the same thing. But in 2019, we're going to take these quantities and then multiply them by these prices. See if I have, no, I thought I had that animated. So we're going to take these quantities and multiply them by these prices. When we do that, we get 818 point. Okay, so the difference between these two numbers is that price effect. Okay, so real GDP was lower and it was actually 818. So we can compare directly this number and this number. The only difference between these two numbers is because of the differences in quantity. Okay, and so since this number is greater than this number, we can say that there has been an increase in economic activity. If we look at 2020, we get real GDP by taking these quantities and going up here and multiplying it by these prices. We're not using these ones because we want to hold the prices constant, right? And when we do that, we get that real GDP is $1,008.75. So again, real GDP so for sure economic activity has increased over this period. But if we just looked at nominal GDP, we would have overstated the amount of increase in economic activity. And that's because there was some, as Zuru said, there are inflation. There was inflation going on here. Prices were changing positively. Now we can look at this on a diagram. So if I graph the nominal GDP, that would have been this line here, right? Real GDP would have been the line underneath, or is the line underneath. And so you can see that nominal GDP here is higher than real GDP. And the difference between these two lines is because of the inflation, the price change. So whenever you want to compare GDP over time, you want to be using real GDP. And almost any figure you see on the news or online in a news article or whatever you're reading, if they're comparing real GDP over time, they're always going to be using, they have to use real GDP. If they're using nominal GDP, then something weird is going on. And usually you'll see something like in brackets, constant, say, 2008 dollars or whatever. So usually there's some indication of what the base year is in the diagram. As soon as you see that, immediately you know that it's real GDP, because sometimes they might just say in the title, right? But if you somewhere you should see an indication that there's a base year or some year in which what prices they used. Okay, now if you have, we'll talk about this next class, but if you had like the consumer price index, you could use that to adjust a nominal series, maybe based on the expenditure approach, into a real GDP. So there's a lot of other things too. Here we're assuming we had the prices and quantity information. But if we don't, and say we had to get GDP through the income approach or expenditure approach, there are still ways of adjusting that data into a real GDP series. We'll talk about that later. Okay, so this is another example. I'm going to leave it for you because we need to get to our quiz. So that's just another example for your homework. Let me check the time here. I think we might only do 4 questions today in our quiz, but anyways, let's just finish up here. So GDP and standard of living, there's a lot of things this measure is useful for. One, it tells us, real GDP anyways, over time, it tells us about the standard of living. Now, another thing too is if we were comparing real GDP, so suppose you were told that real GDP in a country is 1.2 billion, and then in another country it's 500 billion. Can you say anything about the difference in standard of living between the two countries? Anyone want to chime in on that?
Yes, but I need to another thing, like the people, the citizen, how much citizen for this country? Maybe
exactly.
It's more
Yeah.
or they have the lower GDP, but maybe they have more higher standard of living.
Yeah, exactly. So if you just know the real GDP between two countries, the different, it doesn't tell you anything because you don't know how many people are in the country. So if I told you, so if, you have one country with $1 million real GDP, but they have 2 people, that's better than an economy with 100 billion real GDP, but 100 billion people, right? So yeah, you need to scale it by the population. When we're comparing countries, we like to look at per capita real GDP. Okay. And it's simply just real GDP divided by the population. You can think of real GDP as like the economic pie, right? We've produced a bunch of goods and services together as a country. That's our economic pie. That's what has value. We use money as a medium of exchange, but that's really the value. On average, what does each person get of that? That's what per capita GDP is. It's not a perfect measure because it doesn't say anything about the distribution. Some people might get a lot more than others, so it doesn't tell you everything, but it gives you some information, right? So anyways, with real GDP, we're removing any influences of prices, and with real GDP per capita, then, we can compare different countries. So for example, in 2013 for Canada, the real GDP per capita was about $47,809. So a lot of people make more than this. Some people make less. It's not perfect. It's an average. But surely if you were comparing two countries, if one country had 10,000 and another country has 50,000, well, you can definitely say there's some differences in the standard of living, economic standard of living anyway. Concepts here just to keep in mind. Potential GDP. So every year, our real GDP will sort of fluctuate. There's little bits of fluctuations up and down. Mostly they're upwards, right? There's a bit of fluctuation. If we think of the long-term trend, that would be potential GDP. Potential GDP is just the idea of what the best we could do, what the most we could produce of goods and services in a sustainable way, using our resources that we got, using our factors of production. So we could produce more than our potential, but we might have shortages of labor. People would be working too much overtime. Factories are going to be overstressed and that sort of thing. So our potential is given our factors of production, our education levels, our abilities, our resources, our technology, our capital, what's the best we can do. So that's what potential GDP is. Basically, real GDP, even if this is real GDP per person. You could also have this as real GDP as well. But there's going to be fluctuations around the long-term trend, which we can think of as potential GDP. And you can see these are where some of the major recessions were, where you get these dips. So you get that the real GDP was much less than the potential. So that's the 2008 financial crisis. We had there was not too much of a difference here in the tech bubble, but there was a big recession in the early 80s. You can see that there. So I'll just finish up with a quick note on, we're going to get into growth a little more later, but if we take the percentage change in real GDP over time, that's just a measure of the growth of the economy, right? And a percentage change is simply obtained by taking the current value minus the previous value. So the difference as a proportion of the previous value times 100. So here we have GDP in year one of 15.82 billion. Here it's 16.01 billion. Here, real GDP increased by 1.2%. We're just plugging these numbers into the formula here. We can also look at, within a country, look at the percentage change in real GDP. It doesn't have to be per capita, or it could be per capita. Here, if we want to look at real GDP per capita over time, the growth in this quantity, then we just do the same thing. We use this percentage change formula. There's limitations, of course, of GDP as a measure of the standard of living, because it's just looking at essentially the economic well-being. So it doesn't, a country could score very well in terms of its GDP per capita, but maybe people are working 80 hours a week. And maybe another country has the same real GDP per capita, but they only work 60 hours a week. So, the living standard in the country that works more would likely be considered to be lower, right? Also, it doesn't capture things like the underground economy, household production. Doesn't say anything about your health or life. This is economics, so we're just focusing on economic well-being, but keep in mind that it's not always capturing the full story. However, there's usually a strong correlation. Higher income countries tend to have better health, right? They also tend to have better environmental protection quantity. However, not at first. There's something called the environmental Kuznets curve. So when a country starts off developing, it may pollute a lot, but then when it gets to a higher income level, there's more people want to have a cleaner environment, and they have more of the means to be able to do it. So that ends our class for today, and we will see you next week. Take care.